Good day, YouTube. My name is Colin. Thanks for tuning in to another installment of Financial Success. Today, we're going to talk about why actively traded mutual funds even exist. Okay, so for those of you who are kind of new to this or new to investing, a actively traded mutual fund is a fund where you're typically going to pay more fees and you're going to actually have somebody that is collecting money to actively trade different securities or different stocks inside a fund that he or she is managing for a wide group of people. So you're buying into a pool of money that other people have bought into that is actively being invested by a professional. Now, conversely, you have the other thing we're going to talk about, which is an index fund. And an index fund is the same, where you're buying into a pool with a bunch of other people, but this money is not being actively invested. You're not paying a fee to have somebody actively pick out securities for your investment. You're just paying the money that's going to be used for investing, and you're just basically getting a representation of the market. So if you buy into an index fund, say for SPY, which is tracking the S&P 500, you're getting a little bit of each share in of those 500 largest companies. And if they do well, you make money. If they don't do well, you don't make money. So you're getting a little piece of the biggest companies in the market. Now, the first thing you got to understand, and I touched on it as I was explaining the difference and kind of defining what these are, when you have an actively managed mutual fund, you're paying more fees. Now, the fees are all over the place. You know, there's things called front-loaded fees, back-loaded fees. Sometimes there are even hidden fees. And you don't get those with a index fund, but you get them with the mutual fund. So let's just look at a little illustration. This is going to be kind of a conservative illustration. Okay? You got person A that's buying up index funds and person B that is investing in actively traded mutual funds. Okay, now person A, let's say their fees are 0.57%. Okay, they're putting in $12,000 a year, so they're saving $1,000 a month, and in December they're putting all that money into a index fund. Now we're assuming that they're getting an 8% return, and let's say they're putting this in for 25 years. So at the end of 25 years, in this scenario, person A is going to have $807,511. Okay? Now, that's not too shabby. Person B is investing the same amount of money, but person B is going to be investing in an active fund. It's going to get the same return on investment, the 8%, but they're going to be paying 1.21, which is lower than most actively traded mutual funds, but it's still more than most index funds. So this is, like I say, that's why this is conservative. So at the end of the same 25-year period, person B has $736,491. In other words, we're looking at the difference in fees, and that tiny little difference in fees, the difference between 0.57 and 1.21, equated, because of compounding interest, equated to over $70,000 less that person B has than person A. So, okay, so that's the first fundamental thing you got to have, is that these little bit of fees that seem like a small amount are actually a very big amount. And when you compound how much interest you could be gaining if you weren't paying so many fees, it just becomes a much bigger amount than what it might seem. The next thing you got to look at, so a lot of people say, okay, well, you pay a little bit more in fees, but you're getting somebody that's actively going to pick stocks. So of course maybe they'll do better than the market. False. Okay? Most mutual funds do not even match the market. Most of them underperform the market. Now, I'm going to go ahead and kind of talk about something that Warren Buffett did to try to help illustrate this point. For those of you who don't know who Warren Buffett is, he's a big guru. He's the head of Berkshire Hathaway, him and another guy named Charlie. But he's pretty much one of the smartest guys, I think. Great guy I like to look at and get advice from investing. and he issued a challenge to the hedge fund industry. He bet $1 million that they could not put together hedge funds that would outperform the S&P 500 index fund over a 10-year period. So Buffett knew that they couldn't do it, but to illustrate it, he put out a challenge saying, look, I'm just going to pick, he picked the Vanguard S&P 500 index fund, and he said, look, this is going to beat anything you guys can put out there. And he issued the challenge, and I'll kind of summarize what happened. First off, not many people wanted to accept this challenge, which was shocking. Well, not really shocking, but should speak volumes. But he had 5 takers, which is interesting to think about, that he had trouble finding people that would match, that would accept this challenge. So that right there should speak volumes. But he had 5 different funds, okay? And one of the funds got rough 8.7%, another fund got 28.3%, another fund got 62.8%, another fund got 3%, and another fund got about 7.5%. Now, the index fund beat them all by 85%. So it wasn't like it was even close. A lot of these funds did terrible. Some of them did close. Now, this is accounting for fees. But it just goes to show you none of them could beat the index fund. So take into account the fact that it was hard to find people that would actually take on this challenge. And the 5 people who had the cojones to try this, none of them could beat the challenge. So think about the fact that it was hard for him to, actually get somebody that would accept this challenge, and the fact that even the ones who took on this challenge and thought they could do it, none of them could do it. Not a single one of them. It's not like the index fund was, towards the top. No, the index fund beat every other fund that was in that challenge. So over a 10-year period, nobody could touch the index funds. So with all that said, why? You might ask yourself. So okay, they don't do as well as the market. A, B, they cost more than the index funds. So why would anybody in their right mind buy an actively traded mutual fund? Well, I think it's 2 reasons. Maybe one of the reasons I'll put this out there as a benefit of the doubt is that some people just are optimistic. They hear the idea of an actively traded mutual fund and they just think, maybe I think it's going to do better, and they haven't done the research, so they're not educated on it. Maybe that's part of it. Okay? Another part of it is, now there are some people out there who can beat the market, but generally speaking, there's very few of them. So maybe some people think that they've got that guy. And for some people, maybe there is out there, because there's a ton of mutual funds. So perhaps somewhere out there is some people that can do it better than index funds. I think you and I are gonna have a very hard time finding them, and it's pretty much gonna be a lost cause and luck of the draw if we can find them. But we'll say some of it might be people that just have a general optimism. Some of it might be that I think they found the one that can do it for whatever reason. I think the biggest reason that mutual funds exist is because that's what people are sold, and they don't pay attention to what their money is going into. Okay? Most of the time when you go to the bank and you say, I want to set up a Roth IRA, they're going to sit down with you and they're going to say, well, here's some options. And you're talking to a salesperson, and this salesperson wants you to buy something that they can make money on. So then they make money off of fees. So they're going to sell you something that is going to make them money. They're not going to sell you an index fund that's not going to collect any fees. And so you have that. Not only that, a lot of companies, when you have a 401k, they'll only give you certain options, and they may not let you pick anything other than a mutual fund. So you're kind of stuck if you're in that type of situation. You're going to have to pick a mutual fund. Unfortunately, I oftentimes wonder, why is it that you have to pick a mutual fund, and whose pockets are getting lined in that whole situation? But that's neither here nor there. The fact of the matter is, some people are pinned that way. But what I want you to get out of this video is pay attention. And look, if you are one of those people who went to the bank and just set up a fund for retirement, and you went to the bank and they sold you on this, you don't have to keep your money in there, okay? You can pull that money out. You can transfer it. You can go on to E-Trade and transfer that money in over there and stop paying all those fees and buy your own index funds. If you want to know how, let me get up on that comment section. Let me know. I'll make a video on how to do it if people really want a step-by-step tutorial on how that process works, because I've done it. I'd be happy to share it if people want to know. But I think it's kind of one of those slimy things out there that kind of just goes unnoticed by so many people who just don't pay attention to what's happening to their investments. You know, you'll spend so much time clipping coupons to save a little bit of money when you go to the store and buy a can of soup, but those same people will just try to get through a meeting at the bank as short as possible because it's boring and they don't want to figure out and sit down and look at how their money is getting invested. So the biggest reason, I think, is people are making money on it, so they're trying to sell it to middle class, regular people who just aren't paying attention to what they're getting sold on. So hopefully this was enlightening for you. If you enjoyed it, if it was beneficial to you, feel free to leave a like. Feel free to click that subscribe button if you like the content. I'm going to try to keep some more videos coming periodically, hopefully a couple times a month. I'm sorry, a couple times a week. So other than that, my voice is going out on me, so I'll wrap it up here. Thanks for tuning in to Financial Success.